Hello, this is Chad Stayskull from Eagle Wealth Management. I'm here with our Educational Economic Update for October 2017. In this month's video, I'm going to discuss some of the major headlines that influenced markets in September. I also hope to provide some insight into what these developments could mean for you as an investor. As we enter October, the third quarter of 2017 is now behind us. While we still have to wait to receive most quarterly data, one detail is for certain. Major U.S. indexes performed well between July and September. The S&P 500, Dow, and NASDAQ all had positive performance for the month of September as well as for the quarter, and they are each up 9% or more in 2017. With all of this growth, we've seen the indexes hit a number of record highs. The quarter's last trading day on September 29th was no different. The Dow, S&P 500, and NASDAQ all closed at or very near new records. The Dow notched its 8th straight quarter of gains for the first time since 1997, and the S&P also ended up the quarter for the 8th time in a row, with the NASDAQ having its 5th straight quarter of gains. Between the recent weather disasters and geopolitical tension, last month's positive market performance might seem a little surprising. But rather than mirroring this volatility, markets were relatively calm. In fact, the S&P 500 had its least volatile September in history. Now, let's look at what happened last month and what may be on the horizon. Right before the end of September, we received the final reading of Gross Domestic Product, or GDP, a critical measurement of the economy's growth. The data showed 3.1% growth in the second quarter of 2017. This reading slightly beat expectations and indicates the economy is growing faster than most people had anticipated. In addition, the latest reading of personal income and consumer spending increased. The services sector also showed growth, with 15 of the 18 industries in the ISM Non-Manufacturing Index having positive readings. After struggling for years, corporate earnings seem to be back on solid ground. Last quarter marked the first time in 6 years corporate earnings had 2 solid quarters of growth in a row. But the economy still has room for improvement. Industrial production and retail sales fell in their most recent reading. The Fed's preferred inflation indicator, the PCE, once again showed that inflation is far from the 2% rate the Fed hopes to see. Nonetheless, the Fed has stated that it plans to raise interest rates 4 times before the end of 2018. If inflation remains low, they may have to rethink this plan. One change the Fed will be making is to begin lowering their massive balance sheet this month. During the Great Recession, the Fed plunged trillions of dollars into the economy. The Fed now believes the economy is strong enough to handle more normal monetary policy. So far, the markets haven't had as strong reactions to the Fed's long-anticipated decision to reverse its so-called quantitative easing. But we will continue to monitor this activity and a variety of other economic indicators throughout the rest of 2017. Looking ahead, many potential changes could be on the horizon, including tax reform. We are studying how any policy or economic updates could affect the markets. If you have questions about anything in the news or want more guidance, please feel free to give us a call at 541-330-0220. We're happy to talk. Please remember, nothing we talk about here is a recommendation. Once again, this is Chad Stayskull with Eagle Wealth Management, signing off for the month of October 2017. Take care.